Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday, the 2nd of May 2016, and we're addressing the issue of China, PMI, and gold and silver price issues. With gold prices up 22% since the 1st of January, and silver up 29% in US dollar terms, many people are asking why. And is this trend set to continue? Well, a number of factors have affected these prices. Not least of these have been the Fed's rather dovish approach to interest rates, thereby causing the dollar index to decline from 99.6 to its current 93 level. Zero or negative interest rates in many nations throughout the world, including Europe and Asia, ensuring precious metals becoming more attractive for investors, and an acceptance that their significant fall from their 2011 highs may in fact have been overdone. One of the main concerns has been global economic decline, not least the slowdown in the Chinese economy, resulting in their lowering of GDP forecasts to below 7%. Many economists assess future trends based on a number of factors, including GDP. PMIs, Purchasing Managers Index, have also proven to be a significant and frequently accurate forward-looking indicator of commodity prices and economic activity. JP Morgan only last week admitted in its morning note that, quote, stocks are taking their cues from the monthly PMIs, unquote. The manufacturing surveys in particular, as opposed to GDP. China's March PMI reading at 49.7 was not only at its highest since February 2015, but it also crossed above its 3-month moving average, a bullish signal. However, earlier yesterday, it was announced that the official Purchasing Managers Index rose to 50.1 in April, but barely above the 50-point mark that separates expansion in activity from contraction. Analysts polled by Reuters had predicted the reading would improve to 50.4 after upbeat March data fueled hopes that the country's prolonged economic slowdown was easing. According to Tsu Hao, senior emerging market economist at Commerzbank in Singapore, quote, the findings were a little disappointing. To some extent, this hints that recent China enthusiasm has been a bit overpriced, and the data improvement in March is short-lived, unquote. Indeed, South Korea reported April demand from China was the worst in 3 months, with exports to its biggest market tumbling 18.4% on year. And China's factories continue to shed workers, with staff cuts quickening from the previous month. The property recovery appears to have spurred demand for building materials from cement and glass to steel, and a recent rebound in commodity prices is bringing in more cash flow for some companies to service their mountains of debt. However, home sales are now falling in some large cities, such as Shanghai, as authorities try to curb rapid pricing rises, and previously buoyant steel and iron ore markets cooled last week after Chinese securities regulators ordered commodity future exchanges to control speculative trading. Analysts also worry that recent signs of improvement may be largely driven by companies and local government taking on more debt, putting the chances of a stable recovery at risk. China's Big Five banks reported last week that their bad loans had increased by 53.2 billion yuan, or $8.21 billion in the first quarter. On the other side of the coin, however, consumer confidence appears to be increasing as a result of recent house price rises. China's appetite for metals, gold, silver, copper, iron ore and more has also been growing, especially compared to last year. Another sign that its economy may be rebounding. China is the world's largest importer, consumer and producer of gold. Last year, physical delivery from the Shanghai Gold Exchange reached a record number of tons, more than 90% of total global output for 2015. Meanwhile, the People's Bank of China continues to add to its reserves nearly every month and is now the sixth largest holder of gold. According to the World Gold Council, despite China's declared holding of 1,788 tons of gold, it still only amounts to 2.2% of its total foreign reserves, a tiny amount and much less than that held by other world superpowers. This can only lead to one course of action: further demand. This is further supported by its introducing a new fixed price for gold, one that is denominated in Chinese renminbi or yuan. The Shanghai fixed price is designed to give China, especially over time, a greater say in the world price of gold. Copper demand too has increased in China. In fact, it has been reported some 39% more in March compared with the previous year. Caixin reports that China's iron ore imports are surging on lower prices. In the first 2 months of 2016, the country purchased 86% more iron than it needs. What's more, total imports were up 84% from the same time last year. Steel production, which requires iron ore, is likewise rising. Output is currently at 70.65 million tonnes, an increase of nearly 3% year over year. A recent article on Zero Hedge has indicated that China has been growing its silver inventories quite substantially for the past 6 months. This month, as of April 19, the Shanghai Futures Exchange added a massive 1,706 tonnes, which is a 452% increase from the amount it added in April 2015. Shanghai silver inventories are now at their highest level ever. It is rumoured that the proposed growth in solar panels is the prime reason for this demand, something which India too is concerned over and will begin to acquire larger silver volumes. Bank loans in China have spiked dramatically this year, while money supply has grown more than 13% year over year, which is good for metals and manufacturing. The increase in metals demand, not to mention the weakening of the US dollar, has allowed silver to become the top performing commodity of 2016, after recently overtaking gold. So what are we all to make of this? Well, there is no doubt that China has been on a buying spree of precious and industrial metals. The PMI support the reasons for this, though in some quarters it is felt that perhaps the acquisitions have been overdone. It is our contention from our contacts that, overdone or not, China is very much aware of silver supply conditions and its own need to increase gold holdings against its reserve levels. For these reasons, we see their demand continuing to increase yet further, thereby supporting recent price rises. We also see some of the speculative froth coming out of the paper markets and perhaps some price fallbacks in the summer months. However, that said, we could very well see gold rise above $1,300 and silver above $18 to $18.50 in the interim, and at these levels significant resistance will be met. Nevertheless, pullbacks, we believe later in the year, will give purchasers another opportunity to purchase these metals at lower prices but onward looking can see that 2015 may indeed have provided the lows, and that a new paradigm is beginning to emerge. We hope you have found this video interesting and informative, and if so, please give it a thumb up and share it on Twitter. Also kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe as a free member for regular email updates and offers. Our Facebook page, which is updated daily, can be found at facebook.com/IlluminatiSilver. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice, and merely represent the personal views of its owners.